Coming up on Market to Market. Rural America may face a sluggish economic recovery. One federal agency comes clean about its overpayments to farmers. And a noted climatologist puts this season's volatile weather into perspective. Those stories and market analysis with Naomi Blohm next.
This is the Friday, September 6th edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The economic numbers delivered a mixed message this week. On one hand, spending for goods and services has increased, but the number of people making those goods or providing those services has decreased. According to the Labor Department, the unemployment rate fell to 7.3%. While this is the lowest rate since 2008 and the depths of the Great Recession, the lower number fails to reflect people who have stopped looking for work and are no longer being counted. Spending on U.S. construction projects rose 0.6% to its highest level in more than 4 years. Orders to U.S. factories fell 2.4% in July, the largest drop in 4 months. Orders for core capital goods, a measure of business confidence, fell 4% in July. And the Commerce Department says the trade gap rose 13% to $39.1 billion as imports increased and exports fell back. Predicting what will happen with the economy is akin to predicting the weather. You can make a guess, but to make an informed decision, you need hard data. For nearly 2 decades, the folks that put together the Mid-America Business Conditions Index at Creighton University have been gathering information about new orders, production, sales, and employment in states from North Dakota to Arkansas. This week, they released their most recent snapshot of the economy and used it to make predictions about the next 9 months.
As the numbers of the Mid-America Business Conditions Index suggest, the monthly survey found positive growth between July and August. According to this month's report, economic prospects are on pace to close out 2013 at a slight uptick in the 9 Midwestern states where data is collected. Despite the positive outlook, the numbers are down from this time last year. While the index rose 0.3 this month to settle at 53.8, experts caution the numbers are still down from stronger growth in the first quarter of this year. The index uses a scale of 0 through 100, with 50 being considered growth neutral. Numbers above this mark indicate growth.
This economy, I'll say, is limping along, not nearly as strong as we'd like to see. Heading into the fourth quarter of this year, our surveys indicate that growth for the fourth quarter of 2013 is not going to be as strong as what we saw in 2012. And of course, we've got what's going on in the Middle East or not going on. That's creating some real uncertainties, pushing up oil prices. Of course, that's spilling over into our survey.
Crude oil prices climbed to their highest level in more than 2 years before dipping slightly this week as the immediacy of military action in Syria diminished. Investment analysts, however, citing the uncertainty of expanded regional conflict, expected the bullish sentiment to continue. Congress reconvenes Monday, where the issue of Syria is expected to take center stage. Meanwhile, job numbers in the index took a hit, dropping from 55.3 to 52.8 over the 2-month period.
Durable goods continue to outshine the non-durable goods in the area. Food processing is looking better. Agriculture, anything connected to agriculture, and this is very, very important for this part of the region. Agriculture is very important. Growth is not as strong for companies that produce agricultural equipment, not nearly the growth that we've seen. And the air is coming out of the agricultural bubble, but that's not such a bad thing. We have a heck of a lot of air in that bubble for agriculture, and it's pushed up the overall economy.
Exports broke the growth-neutral plane in August, rising briskly to 56.2, up from 50 in July, while imports slumped. The numbers have trended lower in recent months, reflecting slowdown in economic growth.
The Federal Reserve is going to control a lot of that, and unfortunately they're going to be raising rates. I expect at their September the 17th and 18th meeting, I think they're going to say we're going to begin tapering the bond purchase. Now, what the heck does that mean? That means that interest rates are going to begin rising a little bit more. What that means is the value of the dollar will rise. What that will mean is that puts a downward pressure on exports, particularly agriculture. So again, looking ahead, Ag and connected to ag are not going to be nearly as strong in 2013 fourth quarter as they were for 2012 fourth quarter.
The U.S. Forest Service says the 300-square-mile Rim Fire, one of the largest fires in California history, is 80% contained. A hunter who, at one point, was linked to the illegal marijuana industry is being questioned about his role in starting the fire that has cost $81 million to fight. The drought that preceded the fire that burned an area larger than the city of Chicago was just one stage of a weather cycle that stretches back nearly 100 years. The same weather patterns have been affecting farm country for centuries. And one climatologist who has been consulting the historical record says this is nothing new. Paul Yeager explains.
The year after the worst drought in half a century began with a series of rain showers that lasted well into spring planting season. The dramatic change in weather patterns replenished subsoil moisture that had been zapped out the year before. Snowfall in early May added insult to injury in the Corn Belt, delaying planting even further. But for some producers, that flood of moisture evaporated in what seemed like a matter of days. Last week, the Drought Monitor declared a flash drought for portions of the Corn Belt. Those same locations set records for the wettest springs, only to experience a turning of the tables to the driest summer ever. But one noted climatologist questions the validity of the term flash drought.
It's a little bit hard to define because I think someone made the term up for flash floods. I don't think we have a flash drought, but people are talking about it right now because suddenly Iowa's in drought, having been in floods for the spring. Well, we know.
Elwyn Taylor is a climatologist for Iowa State University's Extension Service. Taylor interprets weather patterns of the past to try and predict what may happen in the future. This season's volatile swing in precipitation was paired with a widespread in temperatures. A cold and wet spring was replaced with a hot and dry summer. Several locations in Iowa set records in August for dryness. According to climatologists, the region from the eastern Dakotas through Minnesota and into Wisconsin experienced rainfall last month anywhere from 5 to 25% below normal. Add in excessive heat, crops and pastureland conditions have quickly deteriorated.
We can remind people that aren't old enough to remember or are too old to remember 1936. That was the coldest winter of the century, followed by the hottest summer of the century. Often the extremes both ways go together. The winter was not just cold, it was wet. Summer was not just hot, it was dry.
Earlier this summer, Taylor presented data comparing 2013's pattern to 1947. The historical records show a late July heat wave lasted until early September. This year's blast of hot weather didn't hit full until late August, but still baked corn already on life support from a shallow root system. Back in 1947, an isolated early frost hit some Iowa farmers, but the first hard freeze came well after the state's average of mid-October.
So dry and excessive heat, the combination of the two added up that it became one of the 3 worst years in the history of corn yields in the Midwest.
The Drought Monitor from the University of Nebraska has shown consistent drying the last few weeks across the Corn Belt states of Minnesota, Iowa, Wisconsin, Illinois, and now into Indiana. The hit and miss rainfall over the northern plains and upper Midwest is helping expand the drought conditions in that area. In the Midwest, well above normal temperatures, in some cases 6 to 10 degrees higher, a continued lack of rain and near record low August rainfall in a few areas has led to rapidly declining topsoil moisture, which is evident in corn and soybean fields.
The third day of temperatures over 94 was the day that the damage really began, and significant yield was lost in places where they had temperatures over 94 for 5 days.
Overall this week, 50.09% of the contiguous U.S. is in some form of drought, a slight increase in intensity over last week. Is this a short-term or long-term pattern? The one thing we know, Taylor adds, is the only consistent thing now is inconsistency.
During the next few years, we expect to see more of those kind of conditions such as we had in the 70s and the 80s, because we're past the 18 years of consistent yields now and into the 25-year period, it appears, of greater volatility of weather and a greater need for management of risk in agriculture and everything that's agriculturally dependent. And I would expect that this next 25 years, if we're going this century to have a Dust Bowl-like weather condition, it will be around 2025. These periods seem to be 89 years apart. The Dust Bowl-like condition of the 1800s for Iowa, 1847, 1936. And if things continue as they've done for the past 300 or 400 years, 2025, plus or minus 2 or 3 years.
For Market to Market, I'm Paul Yeager.
Next, the Market to Market Report.
Farmers and ranchers have been operating without a new farm bill for nearly a year. When Congress reconvenes next week, work on the heavily truncated measure will likely be pushed to the side as votes on military action in Syria and raising the debt ceiling take center stage. But USDA continues to manage those aspects of the 2008 Farm Bill that will expire at the end of the month. This includes making payments to farmers and other businesses under a 2009 presidential executive order to reduce wasteful spending. And after some required in-house investigation, it appears USDA overpaid a few customers in 2012.
According to USDA's Office of the Inspector General, the Department of Agriculture paid out $20.3 million more than it should have to farmers and other aid agencies in fiscal year 2012. In a report released this week, USDA identified 239 overpayments, an increase of 67% over 2011, and stated that 6 of USDA's 7 component agencies, quote, struggle to submit reports on time or with any accuracy. The report found instances of overpayment that failed to correspond with supporting documentation. In one case, USDA's Farm Service Agency identified 2 overpayments of more than $45,000 when nothing should have been paid. After this particular case was reviewed by the OIG's office, it was determined that a payment should have been made in the amount of $2,048 to each party. The largest number, as well as the highest dollar amount of overpayments, were processed by the Federal Crop Insurance Corporation. USDA auditors discovered 70 overpayments totaling over $14.5 million. The Food and Nutrition Service, which oversees the Supplemental Nutrition Assistance Program and is famous for stories of its beneficiaries defrauding the government, reported no overpayments. In response to the report, USDA officials agreed to improve the way they identify and document overpayment errors and went on to say that new procedures were put in place at the end of last month.
Early season corn harvest numbers were better than expected, and the prospect of burdensome supplies served to move prices lower. For the week, December wheat lost 6 cents, while the nearby corn contract moved 14 cents lower. Soybean prices trended upward in the light of hot weather and lack of new harvest data as the new crop contract rose a dime. Nearby meal prices increased $5.20 per ton. In the softs, the December cotton contract lost 28 cents per hundredweight. In the dairy market, September Class 3 milk rose 22 cents, while the October contract lost 30 cents. Over in livestock, October cattle fell $1.13. Nearby feeders shed nearly $1, and the October lean hog contract posted a weekly gain of $3.28. In the financials, the euro lost 26 basis points against the dollar. Crude oil gained $2.88 per barrel. COMEX gold lost $9.60 per ounce, and the Goldman Sachs Commodity Index gained 8.5 points to settle at 655.50. Here now to lend us her insight on these and other trends is one of our regular market analysts, Naomi Blohm. Naomi, welcome back.
Thanks, Mike.
We've got a busy month this month, beginning today with the Labor Department's jobs report. Talk to us a little bit about what we saw today and what we can expect throughout the rest of this month.
Yeah, today's report actually was a little bit less than what was expected in terms of jobs, and the bigger issue was the revisions that they had done for prior months. And the reason today's report was supposed to be so important was primarily because it sets the stage for the Fed meeting later this month. The month of September is going to be a very crazy month for reports and global activities. There's 10 reports and big economic news that's happening, and it's almost like if you took everything that gave investors kind of rattled their chains over the past 4 years and put it all into one month, that's what we have in September. So we've got the Fed meeting, we've got Congress coming back to session, we have a big election in Germany coming, USDA report next week, hogs and pigs report, cattle on feed, and the big quarterly stocks report at the end of the month. So this is one of those times where just when you think you can look outside your back door and say, well, I think the corn price is going to do this or that, these outside markets can come in and trump at any time. So you just have to be ready for any scenario that might unfold this month.
It's going to be headline driven throughout the month.
Every other day it's going to be headline driven, and it's one of those things where you say, why is corn up, or why is beans, why are the beans down? And it'll be because something that's happened somewhere in the world. So just be ready for a wild one.
Well, let's dig into it with all of that in mind as we look at the wheat market, continuing to stay relatively flat to a little down this week. What's the broad story there? How should producers be protecting themselves throughout this month?
A great question. The wheat market continues to just kind of slough along sideways, watching the corn and soybean market for direction, and that's going to continue. There was a little bit of excitement earlier in the week that perhaps the crop in Australia or even in parts of South America had some frost issues that had happened, but it's of course not enough to make the market really rally because you don't know what the damage is until you get on down the road a little more. So we'll continue to see that wheat market just trade sideways and try to stay competitive with the global markets. But again, the same issue is that there is such a large global supply of wheat that in order for us to stay competitive, the prices have to stay lower. Ending stocks in the United States continue to shrink, and we'll probably see that a little bit on the report next week from the USDA. But at the same time, what we're going to be watching on for domestic is just more in terms of the feed for animal and see if maybe that category has grown and just kind of continue to see it limp along.
And we did see wheat really take off as a feedstock versus corn throughout this last year. Mm-hmm. Is that projected to continue depending on harvest? I mean, could that be a source of support through this fall and winter?
Yeah, that's a great question, and I think you hit the nail on the head. You're right about that, especially in places in parts of the Midwest where the forage is so low that they're chopping corn early and the yield is horrible, and so the nutrition is low, and so they're going to probably want to continue to use wheat as a substitute for helping with that nutrition. So I think you're right. We'll see that continue to happen, Mike.
All right. Now, as we take a look at corn, as you mentioned, places where they are chopping early, we are seeing some reports of lower yield. We're getting close to harvest. That's what producers looking out their back door are seeing. Again, same question. How do you prepare yourself for this month of activity?
Yeah, it's a wonderful question. And the likeliest scenario for December corn this month is that we'll continue to see it in that $4.50 to $5 range that's been holding it for about a month now. $4.50 is a tremendous support line, and fundamentally, this is a great time for end users to be buying because there is so much variance as far as what is out there for a crop. Early harvested corn in southern Illinois and southern Indiana was actually yielding in the 200 bushel area, so that's kind of what pressured the market a little bit lower this week. But then when you look at the weekly crop progress ratings being down 3 percentage points this week, and then when you look specifically at Iowa and how it's 20 points behind the 10-year average, it really tells a different story. So one of those things that we're not going to know what's out there until harvest. So most likely we'll see prices trade sideways just until harvest comes. Now, the thing with corn, though, is that if the beans can muster up some strength and continue to rally, it's going to take the corn right along with it. But right now, corn is actually following soybeans.
All right, and now you mentioned beans potentially picking up some strength. Is that a strong possibility, do you think?
Absolutely, and I do think that on the USDA report next week, we'll see the USDA cut that soybean number. As long as the soybean yield is still projected to be anywhere around 40 bushel, then we'll see the price of beans easily stay between like $13 and $14. Right now, though, the November contract is trying to defend the $13.50 area because that was that breakaway gap higher. So right now it's saying we want to defend it, we're going to defend it, and then we'll see if the USDA report comes in any lower than 40. If it's lower than 40, that's the news that's needed to get us through that big resistance area up ahead at 1409.
Now, is the trade thinking that 40 bushel is still going to hold, or is everybody just waiting to see what the USDA says?
Well, it's right now the market is trading 40, so if the USDA says 40, it's old news. If the USDA says lower than 40, then that'll acknowledge the extreme heat that we've had over the past 2 weeks, because we are talking to a lot of producers who are telling us how the pods are aborting and how they're not filling out and it just does not look good. So it is going to be a fight to the finish, and ultimately, of course, we have to wait till the combines get going to know what's out there.
And that being said, on the supply side, things are a little, hit or miss. We'll see what happens when the combines roll. On the demand side, are we still seeing very strong international demand? Has that continued?
It's continuing to stay along. For the past couple months, though, of course, Brazil has actually had most of our business, and that makes sense. And so now when our harvest starts again, we'll probably see our demand pick up for the export market again, just because, with the dollar still overall being a little bit lower, we can be competitive again once actually harvest begins. So I do continue to see China as a major buyer overall, and they'll be buying not only from us, but from South America, just on a continuous basis.
Now, looking back at corn and beans, there have been reports that the American farmer really hasn't sold much compared to historical years. For folks in that position, a lot of uncertainty in the field, a lot of variability in the prices. How do you best manage that risk rolling into harvest?
Yeah, that's an important question to talk about, because you hit the nail on the head. There's a lot of guys that just aren't priced. So you have a couple scenarios you can work with here. If you want to just protect yourself, just to have yourself a peace of mind, of course you can do it one of two ways. You can make a cash sale, which I'm not necessarily recommending because you guys don't know what they have out there. But you could also easily put a floor under it with put option strategy. At the same time, though, with the potential really being for higher prices, you can just be ready but have targets higher that you're going to be selling at along the way. But part of that scenario planning and all the big reports that come out this month, if the investors say, phooey, we're done with this, then prices go south even though it has nothing to do with the actual fundamentals of the marketplace, you have to be mentally prepared for that too. So you have to be ready with your plan A if the market goes a lot higher or lower. But overall, anytime we get a little bit of a push higher here, I think it's a good time for a producer to be making some sort of a cash sale if they're comfortable with it, and then a put option strategy if they don't have anything at all.
If they're uncertain, defend those prices.
Absolutely.
Try to lock in some margin.
Especially the beans, they're at all-time highs for this particular November contract.
All right. Now, as we take a look over to the livestock, we have seen fat cattle trade a little bit lower here the past couple weeks. Cash bids are staying relatively strong. Is that going to continue?
Cash market for cattle probably just stay firm from here on out. There's a lot of tiptoeing around to see how long the demand can hold up at these prices. We have traditionally in the month of September, that's when the retailers will put out specials on pork and specials on chicken, because usually there's a supply surplus of pork coming in at this time. So I think people are kind of watching and preparing for that, but at the same time, the production is so low still of cattle, expected to get lower yet into fourth quarter, that we can't really drop prices. So I think we will see it well supported. And the cattle on feed report that'll be coming up also this month, that'll be another big sign to tell us about demand and what actually is out there. So lots of excitement in that market, but overall firm prices to hold is really how I feel it'll be.
Now, as we get ready to roll into the cattle on feed report, is the trade talking assumptions to expect on the report? Are they expecting any surprises? I know last month we saw big declines. Expected to see more declines?
I think that they'll show further declines, but with such a big chunk last month, I don't think that they would do too much this month. And they haven't come out with any of the specific pre-report guesses yet. That'll be probably another week or so, but they are just looking for smaller numbers overall.
All right, keeping the supply tight.
Yes.
Now, as we look over at the feeder cattle market, with these prices, as you mentioned, on corn being a time to perhaps end users get some corn bought, we're seeing feeder cattle also drop a little bit. Is that just a response to the slightly higher corn prices this past week?
It's partly that, but I think the bigger thing is that there's been such a large disconnect between the live cattle price and the feeder price that it kind of needs to come together in some way. Also, if you look at a continuous chart on feeder cattle prices, we're at all-time highs. And so we don't have the news to take it through those levels yet. Well, 160 on the September contract is the high from last year, and we were at 159 this week. So we're seeing a little bit of profit taking, and we're also just continuing to watch the demand and things like that. So my thought would be, if you are an end user, book your feed needs, and then at the same time, if you were a person that had to buy your feeders right now, then maybe in case prices retreat lower, do a put option strategy underneath so you're not feeling so sour if prices do go down.
We get that uncertain, that shock.
Yeah, so exactly. But at the same time, the outlook for the cattle market, because the supply is so small yet and not expected to grow anytime soon, we'll probably see firm prices overall.
There is some bullish support there.
Yeah, there is.
Now let's talk a little bit about the dairy market. Again, we've been treading water really all year in dairy. What do you see here for the next week, couple weeks here in the dairy market?
Sideways prices, and even into fourth quarter, we're looking at an outlook of $17 to $19 range. What's been happening in the milk market, production levels are up 1.1% from a year ago, and that makes sense because the drought really hit production hard last year. So normally when you have a 1% increase in production on milk, that's something that can make the market fall a lot lower. The reason that we're not is because our dairy exports overall are up 13%, and that's what's really supporting the market. With also this week, when the soybeans have gone higher, that's also helped support the milk prices to go higher as well. And just a reminder for those at home who aren't maybe familiar with the dairy industry, break even now for these guys is $17 to $18. It's really shocking when you stop to think about it. So if we can keep prices between 17 and 19, at least that keeps things afloat. But the outlook still is just firm prices for now, and hopefully not any big drama down the road.
Yes, but that export news, that's got to be perhaps a light at the end of the tunnel for these guys. Yeah. Hopefully that will help suck up some of this extra production as we roll into the winter.
Absolutely, and the butter market, of course, put in a strong low, and seasonally butter demand is going to pick up. Cheese demand will pick up as we start to go into the holiday season. So not only will the export market stay strong, but now we'll start to see some domestic demand improve as well.
All right. Now, before we let you go, talk to us a little bit about the hog market. What do you see here coming shortly?
Well, the hog market is having a counter-seasonal move right now. Normally, we see prices slide lower because production is increasing because of breeding patterns. But what's been happening right now is that the weights have been down a little bit because of the heat, and the demand has been hanging in there overall. So the futures market has rallied. It's been partially driven by speculators being in the marketplace. And so it seems like traders are just waiting for the market to drop, but it's not. And the cash market is actually kind of hanging in there. The big hogs and pigs report is at the end of the month, and that only comes out 4 times a year. So what everyone is going to be watching on there, we're expecting this increase for production levels, and so we'll see if it happens or not.
All right. Thank you so much, Naomi.
You're welcome.
That wraps up this edition of Market to Market. But Naomi and I will continue our discussion and answer some of your questions in our Market Plus segment on our website. You'll also find audio podcasts and streaming video of our program, as well as links to our Twitter feed and Facebook account exclusively at the Market to Market website. Be sure to join us again next week when we'll take a look at the most recent supply and demand estimates report. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.